Feed a model one wrong input number and every output downstream, the valuation, the returns, the recommendation are wrong too. And half the time no one catches it until the MD or even worse the client does. In this video we're building a full financial model from scratch for a hypothetical acquisition I call Project Iced Tea, Nestlé acquiring Danone. And we'll start with the step every financial model starts with, and that is getting the real reported financials into the sheet, and this process is called spreading. Get this step wrong and everything else you build on top of it is wrong too. So I'll show you how to do it like an investment banker does. I'm Nico and I spent close to 5 years as a large cap M&A associate at UBS in Zurich. I worked on 20 billion plus of deals. I built the intern training program that they still use today. And I've taught at master programs at University of St. Gallen and Bocconi, teaching the students practical IB insights. And all I do on this channel is share what's working for candidates. And it's what I do on a day-to-day basis at Neverbanked. One-on-one coaching, weekly group calls, and building a community of future investment bankers. The link's in the description for anyone who's interested in learning more, and the Excel file for today's build is there too. So let's get the numbers in. Cover and control tab we covered in a previous video, so check that out if you haven't. But we go straight into the input tabs. What are these for? These are for getting real financials, the historicals, into the model so we can use it later, especially for the operating model, to come up with assumptions for forward-looking estimates. How do we do that? We set up a simple structure. So we need first a few general assumptions. So here, what currency are we using, for instance? As of when is the market data? And all of this is linked to the control tab, where we have one singular assumption for the entire model on this specific hard-plugged figure. F5 enter, we get back to where we were. Same with currency and just a few assumptions for later to make the model itself easier to link and update as well. Next, we have to manually basically come up with the income statement, balance sheet, and cash flow statement using the actual reported historicals. And you do that, as I said, manually, or nowadays you can also leverage AI to get it in there for you. But I'll just show you for a few line items how this is done typically. So 23, let's assume we have that already for the sales, for the revenues. 24 you can find here, 91,354 and 25, 89,490. Important for all these hard-plugged blue numbers is that we have a clear source in the comments. You can press Shift F2 and then you get the comment and you put it in. This just makes auditing your model so much simpler for any senior above you. Growth is simple. It's this divided by the previous year, and then you can pull it to the right with Control R. So it pulls the formula to the right. With F2 and Escape, you can do this. Just a quick note before we move on here. If you downloaded the solutions file in the description below, then you'll see that I calculated the net growth, which is basically this divided by this minus 1, which is the usual way to look at growth. While in the video and the explanation just before, I was showing the gross growth. Usually we take this approach from the solutions file, so feel free to change it accordingly because that's the way it'll flow into the operating model later. Anyway, let's go back into the model. Cost of goods sold. Let's look again in the annual report or the financial statements. Always make sure to pick the consolidated ones, by the way, because these are on a group level and not segments. So we have cost of goods sold for 25 of minus 48,694. And for 24, you see sometimes it's the other way around, but in a standard model, we want to have it left to right. And here we have minus 48,670. And you see the standard convention in financial modeling is that you put expenses in as a negative figure, meaning you can then just simply take the sum here of these items instead of in the formula having to do a minus. And like this, we already landed at the gross profit. We usually have a line item showing the percent of sales, sort of the margins as well. You can plug in various formulas. If you highlight them with Shift right arrow, then you take the plus, you do this divided by the revenue, and then you press Control Enter, and this picks the formula up for all of the lines that you selected. And you keep doing this all the way back to 23. Sometimes you go even 5 years. Usually it's 3 to about 5 years of historicals, just so you can really see the trend. Especially during COVID, we had to go back even further because, of course, COVID years were very distorted. So you had to go back maybe 5 to even 10 years just to see a trend. And you usually use those trends to do the forecasting in the operating model, which we'll be looking at in a later session. Anyway, we can get the same formula, percent of sales here. We can first highlight this, and then with F4, we fix the row, and then I press Control Enter again, meaning I can now copy paste this formula and I get the same one here. So you can then easily basically highlight all of these percent sales and you just plug it into those with Alt H V F, gets you the formulas. And it doesn't mess up your formatting. But anyway, assuming we now filled in all the historicals using this annual report, the reportings, we land at a net income. Important when setting this up is having one defined structure which works across both companies, target and acquirer. So here we often put different items into one bucket. For example, operating expenses, which in this case includes distribution expenses, marketing and administration, as well as research and development costs, less all of these other things. So it's basically a plug to get down to the operating profit. And this is very standard in investment banking, this simplification, because often these specific line items just don't exist in the other company. So you need to come up with realistic assumptions to bucket them into one account. And in this case, we call it operating expenses. Important is, again, you mention exactly what is included in this by including a note with Shift F2. So we got the full P&L now set up all the way down to net income on a group level. Depreciation and amortization is often a special item. Sometimes it's shown directly in here, but oftentimes if it goes straight to operating profit, which is EBIT, which in this case is the case, we do not see D&A immediately. So we need to go into the notes. In this case, it's note 3.1. And here you can see depreciation and amortization for 2025 is 3633. So that's the number we plug in. And again, we include a clear note of where this can be found. The same is done historically. And we can then either take percent of sales or in this case have percent of CapEx. CapEx comes later in the cash flow statement. And now given we have D&A, we can get up to EBITDA, which is EBIT plus D&A. So we take this underlying trading profit because it excludes any non-recurring items, meaning we're basically taking the adjusted EBIT to get the adjusted EBITDA. Because any non-recurring items, as the name says, they need to be normalized for. They're not normal course of business. They're things like fines you might have received or restructuring costs. And these are things that don't happen in the normal course of business. And the final thing to close out the income statement bit are the shares outstanding and the EPS, the earnings per share, and the DPS, dividends per share. Here, for the earnings per share, you need to take the weighted average shares outstanding, or the WASO it's called. And here in this case, it can be found in note 15 of the financial statements as earnings per share. And for 2025, it's 2573 and 2596 for 24. And this is the weighted average of the shares over a certain period of time. So that matches the earnings because that's net income is also a profit and loss item over the period and it's not at one specific point in time. Meaning you take that, you simply divide net income by this figure and you get 3.51 as the basic earnings per share. For dividends per share, I simply took the reported figures. Here, one note for the dividends, you need the point in time shares, meaning you usually take how many shares did the company have at the end of the period, and that's the share count you take for the dividends. Because a dividend is a payment now at one point in time and not over a certain period. That's that for the income statement. Let's go to the balance sheet. So again, we take the consolidated balance sheet as of a point in time, the 31st of December in 25, and we start manually plugging the things over. I've already done this for you. So you see, for example, 4579 is cash. Important here again, we bucket any special sort of small items into other current assets or liabilities. And in this case, it's everything below trade receivables, so account receivables, which we plug into this specific number. Again, that's to be able to ultimately combine the statements when we get to the merger model later, because maybe assets for sale just doesn't exist in the target company as an account. And then it gets hard to combine and super complex because you need loads of different line items, which ultimately don't move the needle. You take the sum of this, then you do the same for the non-current assets to get the total assets. Same thing for the liabilities and the equity. And ultimately you can include a check just to make sure that the numbers match. So always make sure the sums, you take them and you don't just hard plug them as well, because like this you can quickly check if there's any mistake and where is the mistake compared to the actual reported figures. But here we see they match whatever was reported. We can do a check here as well, just subtracting one from the other. And this usually we then link it into the control tab, into this check section. Meaning we have here clearly in the control tab, we can see if there's any mistakes or any mistakes that suddenly pop up, they will show up here and you can then spot exactly in which tab the mistake is. F5 and enter, it takes me back to where I was. And here I suggest we start calculating the debt and the net debt, because this will be needed later on as well. So for debt, we just take the sum of short-term financial debt and long-term financial debt. This is the interest-bearing debt that the company has. And this, by the way, also includes the lease liabilities since the introduction of IFRS 16 back in 2019 for any IFRS reporting company. And just the logic behind IFRS 16 very quickly is that leases before were classified as operating or financial leases. Operating were not on the balance sheet and financial were on the balance sheet. Nowadays, this does not exist anymore under IFRS 16, but all of the leases are classified as financial leases, or nowadays called right of use assets. And for this, there is an asset and a corresponding liability, the lease liability and the right of use asset. And this lease liability has lease interest, and that's why it's classified as an interest-bearing financial debt. Anyway, back to total debt, it's the sum of those two, and then you subtract any cash and short-term investment, so anything that is highly liquid, to get the net debt, the net financial debt. And then we can calculate a few ratios as well. Net debt divided by the EBITDA of this year, or the implied cost of debt, to just get a feel of how much an interest rate could be for an outstanding, just to get a feel for how much their interest cost really is. And this is usually done by taking the average of the beginning and ending period, meaning last year's ending balance and this year's ending balance, divided by the interest cost paid throughout that period. And the reason for taking the average level of debt is because otherwise you'd be comparing a point in time debt figure to a period, a flow metric, which is the interest paid, which happens throughout the year. So you approximate that by just taking the average and then comparing that to this flow metric. That will become very relevant when we do the LBO and the merger model, by the way. And like this, we have the balance sheet ready. Then we get to the cash flow statement. The indirect one is the usual one you use, meaning you start with net income. You link this directly up here. And then again, you start filling in the items which are reported. Here again, working capital is one which you need later. You need depreciation and amortization and impairment, which is why it's not exactly the same figure as we have up here. And anything else is, again, they're usually smaller items, so you can just bucket them into an other piece, making sure that the ultimate sum matches what we need. So 15,904 is the operating cash flow, and we get this. Again, this helps us then afterwards combine the two financial statements when we get to the merger model. Then we subtract the capex and the investments in intangible assets to get sort of a free cash flow metric. Here you could also split it into the full investing cash flow, having a full operating cash flow and the financing cash flow. But to make life easier later when we start forecasting the free cash flow in the DCF, I've bundled it all into this capex figure and included the rest here below to get the net change in cash ultimately. Here we have to subtract a few finance related cash outflows and the remaining outflows that we're missing in the other activities, again bundled into a few sort of buckets which are easy to understand instead of having all of these listed out separately. Again, here is important that these numbers match what is actually reported. And it might seem wrong now. So 740, for example, for 2020. And here it's important that these numbers match what's reported down here. It might seem wrong now, 740 for 2024, while it's 742. And that's because in this item, we've included the cash classified as held for sale, meaning these two down here are also included in the number, meaning 742 minus 2 gives us 740. The same over here, and there's always a few rounding differences, which ultimately the importance is that this check works. But ultimately important is that this check in the end works, meaning that this change in cash matches the change in cash in the balance sheet, and then you know it's all flowing correctly. Last, we have to fill in a bit of market data. Here, these numbers we already have. We have the shares outstanding up here. One note, this is the weighted average shares outstanding, yes, but for simplicity to just have one number, we'll be using this. To get the market cap, it's share price times the shares outstanding. The total debt we've computed up here. The cash and short-term investments we've already subtracted here. So we already have the net debt calculated as this minus that. We have non-controlling interest also already up here in the balance sheet under the equity items. And we subtract investments in equity accounted companies to get the enterprise value. Why do we subtract investments in equity accounted companies and add non-controlling interest? Non-controlling interest means we own over 50% of a company and you less than 100%, meaning that we do fully consolidate the company, but there is still a so-called minority interest. Let's say we own 70%, that means the minority interest is the remaining 30%. So on a income statement, a balance sheet level, we are fully consolidating this company into it as if we own it 100%, but then we have to get rid of the remaining 30% in the income statement by subtracting it here. So we have the net income on a group level, but then we get rid of it saying this is the actual net income that goes to the group's shareholders. And the same on the balance sheet. We have a separate line item splitting out what is the non-controlling interest portion. Equity accounted companies, you own 20 to 50% of the company, so you have a significant share, but you do not fully consolidate it. Meaning it's like a single investment into this company, but you do have a significant stake in it. So you do have a sort of say in the way the company is managed because you own 30%, for instance, but only a portion, 30% of the net income flows into your net income, while the rest is not. Meaning on an enterprise value, to make sure that you're showing it like for like, you have to get rid of this equity accounted company portion because the EBITDA does not include anything of this equity accounted company. So the EV should not either. While on an equity basis, this is already baked in. So you don't have to make any adjustments there. Anyway, we got the enterprise value by adding market cap plus net debt plus this minus that. And we land here. Then we can also extract a few market related figures just for later to understand is the valuation we got high or low, comparing to the highest and lowest share price over the last 52 weeks and a few other figures. We can also start computing the implied multiples. So EV to EBITDA, we divide the EV over the EBITDA on top. Price to earnings, so we take the price dividing it by the earnings per share, or the net debt to EBITDA to see how much leverage does the company have at this date. And like this, we have the input for one company and we can do the exact same thing for the target, which is Danone in this case, making sure it's in the exact same structure, especially on a line item by line item basis, because otherwise you cannot accurately combine the statements later, let alone forecast each of them and then come up with a sensible analysis. That's for the historicals. Now let's look into the future. What can we do here? We can either go to the management if you're working close with them and ask for their projections. Those are usually the most direct source you can get from someone who really knows the business and the industry. If you don't have access to that, then you can use broker estimates, meaning you go into the reports that equity research analysts write and they have projections there out into the future. You can also get access to that data by linking your Excel directly to FactSet or Bloomberg and getting those data directly pulled. In this case, we're using public sources. So we're using Market Screener, which is fine. It's not great, but it's fine for this purpose. And the main source we always have to use first is going into the company's website under investor relations, is going into the company's website under investor relations, and there you can find published consensus estimates or even guidance figures that they might have. For Nestlé, we'll look at this as an example. First, we start with the near-term forecast, which is 2026 in this case. And you can see they actually publish this in a report looking at the estimates of the brokers covering their stock and what they say. So we take that source because that's the one the client, the company knows, and we can trust that it's accurate, or at least that they know what we're talking about. And we start filling this in. So 89,276 is for 2026 sales, and we subtract the cost of goods sold. So again, we manually go and get these numbers. 89,276 for sales, we subtract 48,184, and then we get gross profit. You see, this is not fully matching what they report. Reason for this is, look over here, there's 18 broker estimates for the sales, but only 14 for the cost of goods sold and 14 for this. This means that you can't just take the sum because this is also an estimate and it doesn't include the 4 that were included in the sales estimate. Which means for our model, we will be keeping it consistent and just taking what we have and then taking the sum. So in itself, the computation makes sense. And we do the same going down all the way to net income. And here we get something which is close to what they have. Again, this is an estimate of 18 brokers, but we're calculating it down here, making sure that our computations based on these line item assumptions is accurate. Going forward into 26, 27, Nestlé did not report anything. So we need to look at these. And here, this is a screenshot from Market Screener. It's publicly available for huge companies like this and free. But if you're working at an investment bank, of course, you use Bloomberg, FactSet, Capital IQ, which is much more accurate. And you can easily refresh these things. But for these simple purposes, we will use this. Again, we manually plug them, 92,823, 95, 913 for 27, 28. And whatever we have, there's not always availability on every single line item, but whatever we have, we plug it into the model. So we have it all in one structured place. Same goes here for the EBITDA. We don't have a forecast for the D&A, but we can then back solve it by taking the difference again of the trading profit and the EBITDA. And these remaining items, which are important down the line for our other analysis that are to come. CapEx, because we need to forecast the free cash flow. Net debt, because we need to understand how is the general debt schedule of the existing debt, so we can model the new incremental acquisition debt on top. And earnings per share to come up with an accretion dilution analysis for the merger model, and dividend per share to understand how many dividends are expected to go out, and that's a cash outflow when we get to the LBO, for instance. Then lastly, we can also sense check the figures, looking at what do they, in for example their investor presentations or capital markets day presentations, what do they forecast or give a guidance to. And you can do this control Fing guidance or forecast within those documents. And for Nestlé, for instance, they expect for 26 a 3 to 4% growth. And consensus in this case is 3.4. So we see, okay, consensus is within that range, meaning it does make sense and it's not completely off. And that's a simple and very manual way to get the consensus estimates for a publicly listed company like Nestlé or Danone. Danone, we basically copy paste the entire structure again and use the exact same approach to come up with its consensus estimates. So that's both companies spread. Every reported number and consensus estimate traceable back to a source. And with clean historicals and consensus estimates in place, we next forecast into the future. And that's the operating model, the engine for the rest of this financial model. With clean historicals and consensus estimates in place, we next forecast further into the future. And that's the operating model, the engine that everything else runs on. The Excel file to follow along, it's linked below, and so is a free AI workflow for this stage of the model. Now hit that subscribe button to not miss how to build an operating model. And I'll see you in the next one.